Will the switch away from the London interbank operating rate to the new benchmark, will that cause a crash in tens of trillions or hundreds of trillions in derivatives? So over the last week or so, there's been a number of people in the alternative media and the gold and silver space, including my friend George Gammon and also Lynette Zhang, who I think is very smart and respect, talk about this. However, given what has happened and what I know about what has gone on behind the scenes, my extra research into the subject, and there's a lot of extra information and articles behind the paywall for my Patreon account contributors about the derivatives market, about what I've learned in the last 10 to 12 years. And I've gathered information from sources that were in high-level IMF meetings in 2014, information that was given to me and not to anyone else. And then the rest of the gold and silver community found out through me. I know because I had private conversations with Eric Sprott in Toronto about this, as well as other people. And then the information started appearing everywhere else. But there's tons and tons of examples over the last 10 to 12 years in the derivatives market. And by the way, in the over-the-counter derivatives market now, we're at 1.2 quadrillion in gross notional size now. It is insane. Okay, it should never have gotten this big. It is way too big, but this is the casino. This is where the large banks, the hedge funds, the family offices, the institutional investors, the bond fund managers, this is where they make all their money, especially the large banks, because the deflationistas will say that it's not inflationary if the large banks gamble away all of their reserves at the casino. Gambling on derivatives, gambling on leverage bets on bonds, gambling on leverage bets on currencies, gambling on all kinds of stupid leverage bets. Heads we win, tails you lose. And then guess what? If their bets blow up, they get a refill of the reserves. They get to go back to the casino. And they get to keep their bonuses and their stock options. And the average Joe or Jane on Main Street doesn't know any of this shit, because the mainstream financial media won't cover it accurately, because the banks make tens of billions per year. There's estimates over 30 billion per year if you add up all the large banks in derivatives trading and other leverage trades, and they don't want people knowing how it gets done. It's intentionally done this way. The banks actually don't have to make a single dollar more in loans to make tens of billions per year in profits. Okay, that just gets in the way of them going to the casino. It's all about the casino. That's where the majority of the profits are. It's in this OPEC casino, gambling on derivatives, setting up these sophisticated leverage trades on bonds, currencies, and derivatives. So over the last 10 to 12 years, from the sources I've spoken to, the stuff I've read, and I've interviewed Rob Kirby and others, there's been derivative failures over the last 10 to 12 years. There was a lot of derivative failures in 2007, 8, and 9. And guess what? They were all papered over by tens of trillions in bailouts, by an insane amount of currency swap lines, mostly currency swap lines. That was the bailout of choice. Why? Because the Federal Reserve, unlike what's being saying in a lot of these articles and these other people that are saying that this is going to blow up the derivatives market, these currency swap lines can be forgiven. So the Fed gives out these loans for trillions of dollars and then waives them. Oh, and then guess what? They give out trillions of dollars more in loans to the European Central Bank and European banks, because that's where the majority of the problems are. Probably started with the Eurodollar, and probably why the European Central Bank has had permanent currency swap lines, according to research I found in a Federal Reserve paper out in May, and there's screenshots of this proving this evidence for my Patreon account contributors. So the permanent currency swap lines are there to paper over problems at the casino, to paper over derivatives failures. So there's been lots of derivatives failures for years now, at least a decade. And most of the time, we never find out about them. That is the truth. We never find out about them. Maybe we find out about them a little bit later if we're lucky. Maybe. We found out through the one-time partial audit that Ron Paul got at the Fed. We found out through the Freedom of Information Act that Bloomberg News got, that the Levy Institute went and found that $29 trillion, at least $29 trillion, had to be given out in the 2008 financial crisis to paper over derivatives losses on things like interest rate swaps and other garbage. Okay, how many derivatives were tied to Libor, the London interbank operating rate? It's estimated over $300 trillion in gross derivatives are tied to Libor. So, do I think that the people in power, the politicians, the central bankers, the large banks, the CEOs of the large banks, do I think they're going to let these things fail when this is where the majority of their profits come from? Absolutely not. I think they're going to change the rules. And whenever they get in trouble, and there's been tons and tons of derivatives failures, they change the rules all the time. And most of the time, we never find out about the rules changes until it is way too late, if at all. We just don't find out about the rules changes because they don't want us to. Because they want you to be the normal, brainwashed, plugged into the matrix, go watch sports, go watch movies, go watch your little TV shows, go watch your reality TV, go swipe right on your little dating apps. They want you to be a normal little, busy little person and not worry that Joe and Jane Bankster and the central bankers and the government employees are robbing you blind through purchasing power theft. So, this goes back to rule number 1. For those of you that are new here, politicians and governments can and will change the rules anytime they want. Perhaps on a daily basis, moving the goalposts, changing things retroactively, moving targets. And the derivatives market is the largest, biggest problem. It is not the euro-dollar market, as Jeffrey Snyder claims. The euro-dollar market is an order of magnitude at least smaller than the derivatives market. The derivatives market is the biggest problem on planet Earth, financially. The absolute biggest problem. It is way too big. It should never have gotten this big. There is no reason for the derivatives market to be 1.2 quadrillion or 1.4 quadrillion in gross notional value. No reason whatsoever. Okay, for derivatives, interest rate swaps, bets on currencies. Okay, there's been problems with the Chinese banking system since at least 2014. There was Federal Reserve minutes going back years ago talking about the Chinese banking system was on the ropes. 2014, 2015, 2016. Kyle Bass, the Bank of International Settlements, has talked about it. In the Fed minutes, they talked about this as well, about problems in the Chinese banking system. And then guess what? Guess what the Chinese banks did? They went and they opened up tens of trillions. There's estimate out there from the Bank of International Settlements, almost $14 trillion, and I've talked about this a lot in the past, of forward dollar swaps. So they didn't run out of dollars. So they went to derivatives. And then guess what happened when the oil market went negative? The Bank of China. I spoke to a hedge fund manager who trades tons of Chinese stocks, has tons of information inside China. And what the hedge fund manager said, and this wasn't Kyle Bass, another one. And what the hedge fund manager said was the Bank of China, when the oil market went negative, briefly, the Bank of China had over $100 billion in a week in derivatives losses over the counter. And it was probably papered over. Maybe the Federal Reserve helped out. Maybe the People's Bank of China helped out. Who knows? We may never know the truth. But these currency swaps, and I've spoken with my friend, and I respect Brent Johnson a lot. But with these currency swap lines, what the Federal Reserve can do with them, and the Fed is the only one that can do this because the dollar is a world reserve currency, the Fed can issue currency swap lines of trillions of dollars to a large entity like the European Central Bank to paper over temporarily the euro dollar market and then forgive the loan. And then guess what? They can give out another currency swap line for trillions of dollars if there's another problem a year or 2 years later, and then they can forgive the loan. And guess what? They can keep on doing this. And that's pretty much, in my opinion, how this system, this bubblegum and duct tape of a joke system, has been limping around since 2008 and 2009. It's been currency swap line bailouts, putting out derivatives fires. There's been derivatives failures a lot. My voice is starting to go. I need some water. There's been derivatives failures, in my opinion, a lot of them that have been covered up, not brought out publicly, a lot of them by large banks and central banks that have papered over it for the last 12 years. So, no, I don't think, and maybe I'll be proven wrong, maybe this time will be different. I do not think that this derivatives failure will be the one that takes them all down, because the people in power are well aware that the derivatives market can take them down. However, they know that that's where their profits are. That's the casino. That's the opaque, high stakes, high leverage, big profit, heads we win, tails you lose. Profits are privatized, lots of stock option bonuses, lots of job promotions, and the taxpayers and the holders of those currency units eat the losses at the derivatives table. So no, I don't think those derivatives are going to explode. Okay, let me read the article here. This is from Bloomberg. It was reposted on the American Banker and elsewhere, and Lynette Zhang and George Gammon are making videos about it. But again, this goes back to rule number one. I think the large banks, and I think the central banks, and I think the governments, they're just going to change the rules so they don't fail. And we may never even know about the rules changes. We may not. Do you think they're going to send out press releases for all of them? Or do you think we got this article, but do you think we're going to be getting a bunch of press releases that, oh, the derivatives market are fine and all this? I don't know if we're going to get those press releases. Normally, they don't even tell us the truth. Big banks, banks brace for big bang, switch on 80 trillion worth of swaps. It's being called the Big Bang, and it has derivatives traders on high alert in a critical development in the global shift away from old benchmarks that was triggered by Libor's London interbank operating rate shortcomings. Interest rate swaps on more than 80 trillion in notional debt will transition this weekend to a new rate for determining their value. The article's from October 15th. While the switch to the Secured Overnight Financing Rate, or SOFR, is expected to boost longer-term liquidity in the new benchmark, actually, I have an article here from August 21st with institutional bank analyst. He's really good, Christopher Whalen. He was writing about this on August 21st. So Libor is dead, long live SOFR, really. Talking about the problems with that and how it's all the different problems with SOFR. So if you want to read more on that, I'll put that article in the information description section. Also, he talks in there about forward TBA contracts. If you don't know what those are, I have the Investopedia definitions for those. So that's a forward settling mortgage-backed security trade, or pass-through securities issued by Freddie Mac, Fannie Mae, Ginnie Mae. So if you want to read more about that, again, the articles, the definitions on those will be below the video in the information and description section. While the switch to the Secured Overnight Financing Rate, or SOFR, is expected to boost longer-term liquidity in the new benchmark, it also is fueling concerns about unruly price action because it is expected to trigger the sale of swaps on tens of billions of dollars of debt. Quote, the Big Bang, and what's to stop a central bank from the Federal Reserve from expanding its balance sheet and buying this, or creating a new facility that's only temporary, and saying, oh, the Federal Reserve is going to create this is just hypothetical. Let's see, the Federal Reserve creates a new facility and says, we're going to temporarily buy all these things that are going to blow up. We're going to work on fixing them. We're going to stick them in there like a bad bank. And then when we have them fixed, then we're going to resell them. There's nothing to stop in a fiat currency system where the central banks have way too much power. And the Federal Reserve can create basically unlimited currency and credit, especially to bail out other central banks and large banks to save the system. And I'm using air quotes. There's nothing to really stop that, especially when the deflationists are going to say that this is going to prevent deflation and we need to fight deflation, because that's what the deflationists keep saying. And I've gotten Brent Johnson. I've talked about this stuff with Brent Johnson with the swaps. If the Federal Reserve actually forgives currency swap lines, that he said that his probability of a large dollar spike, his rip your face off dollar rally, the probability of that would go down a lot. So he's publicly said that to me on Twitter and elsewhere. So he's disputed that the Fed will actually do that, but I would say that the Fed has already been doing that for the last 12 years. That they've been issuing currency swap lines when the European Union was in trouble, when there was problems with the pigs, Portugal, Italy, Ireland, Greece, Spain, when there was problems there with the European banks and derivatives, because the European banks were never recapitalized, and the European banks created a lot of the problems in the euro-dollar market and derivatives. So my educated guess, based on a lot of the information I've gathered and sources I've spoken to, is that the Fed has issued, and there's a lot of evidence for this, a lot of swap lines over the last 12 years. And then when the temporary liquidity crisis with a derivatives problem is over, the swap lines are canceled. So the entity, whether that's a European bank or a central bank like the European Central Bank, doesn't have to pay them back. Excuse me. My voice is starting to go. I don't know why. Quote, the Big Bang is one of the most important steps in the Libor transition, said Marcus Bennett, director of SOFR Academy, an educational technology firm whose clients include banks and asset managers. I guess I just need a little bit of water. Quote, we expect, my voice is sounding a little better. We expect rates, desks from the largest banks in New York to be participating. The reset, which will see SOFR replace effective federal funds rate in calculations that value swaps, is part of a push to make SOFR a standard U.S. reference rate in debt and derivatives markets. SOFR is intended to replace dollar Libor, which still underpins hundreds of trillions of dollars of assets such as mortgages in the US and syndicated loans in Asia. The Big Bang follows a smaller scale pivot in Europe this July, a less complicated switch that occurred without much impact on the market. Interest rate swaps allow two parties to trade one stream of payments for another over a set period of time. The most common variety, known as a vanilla swap, involves exchanging payments from a fixed rate for payments from an adjustable rate that's based on Libor or some other reference rate. Rob Kirby has derivatives expert and trader Rob Kirby has talked about this. He thinks the Exchange Stabilization Fund is heavily involved in this. But the fact of the matter is that the banks bet on the Federal Reserve and other global central banks manipulating interest rates lower, and they've made enormous profits in the derivatives market, gambling on interest rates going lower because they knew that interest rates would be manipulated lower over the last 10 years. So they did a lot of interest rate swaps. They increased the amount of interest rate swaps an insane amount since 2009 and 10. They exploded even higher. Another kind, known as a basis swap, involves two adjustable rates. While SOFR has struggled to gain traction, adjustable rates would blow up if interest rates spiked. And if the banks bet on lower interest rates and interest rate spikes, the banks would blow up and they would need bailouts. While SOFR has struggled to gain traction since its introduction in 2018, analysts said the upcoming Big Bang has already triggered a shift toward more trading in SOFR-linked swaps. This could help pave the way for a curve that reflects expectations for where the rate will be in the future. Addressing one of the new benchmark's key weaknesses, the Big Bang will have a very good impact on liquidity, said Jason Granett, Chief Libor Transition Officer at Goldman Sachs. Compensation. Still in the immediate future, there will be turbulence in pricing. Clearinghouses are planning to effectively neutralize the change in swap values caused by the Big Bang, and traders will see their positions automatically adjusted. LCH, CME Group are both preparing to distribute compensation from clients whose positions values go up to those who see them decline. LCH will facilitate payment of hundreds of millions of dollars in cash to cover lost value and at least tens of billions of dollars in basis swaps to compensate for risk, said David Horner, head of risk at SwapClear, which is part of LCH. However, some firms do not use basis swaps to hedge their discount rate risk or are otherwise incapable of keeping them on their books, so they are expected to sell them. This Friday, LCH will hold auctions at which 18 banks can close out $25 billion in unwanted basis swaps. Buyers ideally would snap them up either as hedges against risk or for their own value, but the approach is largely untested since basis swaps were not distributed in the European version of the Big Bang. Quote, for about 6 months, our members and clients have been able to look on their screens and see forecasts for the compensating cash payments and compensating swaps they will receive, so they are familiar with what's about to happen, said Horner. Quote, it's important for the market that it runs smoothly. CME will hold a similar auction on Monday. Clients have agreed to a maximum loss, said Sunil Coutinho, president of CME Clearing, and if their positions cannot be auctioned off, then they are fully protected and they can use their own private means to dispose of their positions. And I think also if there's any problems, I think the Fed, because we're in this just ridiculous new normal now, the Fed can literally create a new bailout facility within the next couple days, not actually have to buy anything, issue press releases that they will buy stuff for enormous sums of currency units, and then that will stabilize the quote-unquote, air quote here, because it's not real markets. There is no real price discovery. We only have manipulations. All that's left is bailouts and rules changes at this point, markets. So the Fed is really good at this point since February and March at press release manipulation without actually having to buy anything. Although I think at this point on the Fed's official balance sheet, I think the amount of net decline of the Fed's official balance sheet, the correction period is over. And I suspect with the lack of foreigners wanting to buy U.S. Treasuries and how big the official U.S. federal government budget deficits and the potential stimulus plan that Jerome Powell is begging Congress to do so he can lend it and Congress could spend it, and then potentially, depending upon how the elections go in the next couple weeks, Congress with MMT and universal basic income. I mean, we're looking at way over $3 trillion year budget deficits. And the Fed is the buyer of last resort. I mean, the big banks can buy treasuries. How much more treasuries can the pension funds buy? Or the pension fund's going to be able to buy a lot more treasuries. So really, at this point, I think the main buyer of U.S. treasuries is going to be the Federal Reserve. So the Federal Reserve's balance sheet, and the Federal Reserve's also buying a lot of mortgage-backed securities each month. And they're going to have to buy a lot more of those bonds, too. Those corporate bonds, those investment grade, in air quotes, corporate bonds that were added to the corporate bond bubble when there was already no cash flow to service the existing corporate bond bubble prior to the last 7 months. And then another 1.3 trillion plus in new corporate debt, in investment grade corporate debt, junk bonds and leverage loans were added without cash flow that can service them. So the Fed's going to have to buy at some point in the next couple years, probably under 2 years, many trillions. I would not be shocked if the next 2 or 3 years, if the Fed's balance sheet is over 15 trillion. Let's just put it that way. That's how bad the budget. If you start doing some projections here on how much corporate bonds and junk bonds and leverage loans and collateralized loan obligations and then MMT and universal basic income and infrastructure spending and federal government budget deficits, because the federal government here in the DC metro area never cuts back, regardless of which party. I mean, maybe normally what happens is the budget is just moved around. So each party has their pet projects. Like Democrats will pick out green energy projects and more social program spending, and the Republicans will want to, Trump will want to, he just did a press conference this week, I think, talking about 2.5. He admitted publicly, which I didn't even know, he admitted a public number. I don't know, I haven't seen a fact check. He said 2.5 trillion in new military spending has been done the last couple of years under his administration. So that number I don't think is added. That number is off balance sheet then, because that has not been added to the Fed's balance sheet, that extra 2.5 trillion. So that would be maybe part of that missing 21 trillion or more that Catherine Austin Fitts and Dr. Mark Skidmore have been talking about for a while. But about 80%, most people are unaware of this, about 80% of the U.S. federal government budget is locked in for the next 5 years. So neither party, not Congress, not a bunch of Wesley Mouch bureaucrats, not Bernie Sanders can fully alter that budget. It's locked in for 5 years. Now they can move some money around. They can move some money around to different industries and different projects, like Bernie Sanders or AOC or Joe Biden would want more spending on green energy and healthcare and social programs. And if President Trump wins re-election, he'll probably want to spend even more on military and maybe on infrastructure. But the amount of spending it's not cut. It's just moved around. And normally it's increased, actually. But in the past, the U.S. was able to export those dollars outside the United States. And that offset the amount of monetary inflation. But I don't think that's going to be the case this time. Okay, let me finish this article. CME will hold similar auction on Monday. Clients have agreed maximum loss. Okay, however, they are concerned about price swings in the market amid a surge in supply as some banks ditch basis swaps they received as compensation. Oh, because these are no longer the profitable casino trades that they once were. It's more profitable to go gamble on roulette or at the card table. I like the casino analogy because there's all those risky casino games and the banks just get a refill. If they blow their load at one of the tables, they don't go to prison. They don't get in trouble. They do money laundering, they don't go to prison. Very rarely, maybe they pay a fine. Cost of doing business, they pay a tiny fraction of their felony profits. Okay, the big question is how well the auctions go. Clearinghouses are not guaranteeing the minimum prices based on swaps, which could fall below the maximum the firms are prepared to tolerate, which means if there's any problems, the Fed probably has to step in and create this fake bailout facility where they actually just issue press releases and don't buy anything. I'm still adding these parts into the article here. Quote, many would then likely unwind them in the open market and the price, pretending we sell markets here, price action could get very disorderly. Firms need to understand that they are facing more risk from this change first before they eventually get less risk, said Peter Van, I'm going to screw this last name up, Verdenberch, a principal at Market Alpha Advisors, previously a member of the Alternative Reference Rates Committee, which is guiding the U.S. Libor transition when he worked for HSBC Bank Holdings. That's not good, in 2016. Quote, the big banks are very prepared for the Big Bang, said Van Vredenberch. Yeah, they're prepared because they know the Fed will just buy this toxic garbage from them or create a new bailout facility, or issue press releases about a new bailout facility, not actually buy anything for 6 months or a year, but that's good enough for most financial professionals. And it'll be back to trading as normal, just like in how all the corporate bonds were issued, all the investment grade corporate bonds and junk bonds and the leverage loans and the collateralized loan obligations and the mortgage-backed securities and all this other toxic garbage that's been issued since March and April. That's exploded again in amount of issuance. The Wall Street toxic sausage making machine. Quote, but do I think the smaller banks are ready for this? Not even close yet, because the Fed doesn't protect the smaller banks. The Fed has all these fuck you laws in place to screw over the credit unions and the small banks. Do you think the small banks get access to the Fed's bailout facilities? Hell no. The Fed has dozens and dozens of rules, regulations, hoops, and all these procedures that the little banks and the credit unions have to go through just to get a tiny amount of bailout money. It's only JP Morgan and Wells Fargo and Bank of America and Citibank and Goldman Sachs when they converted to a holding company, but Goldman Sachs doesn't want to give out any loans. Goldman Sachs just wanted access to easy currency and credit, easy reserves, so they can dock cash at the Fed, make interest on the reserves, use that as collateral, and take that collateral, and guess what? Go gamble at the casino. Welcome to dystopia. The casino runs things. And the Federal Reserve, I guess, is like the pitmaster at the casino. The Federal Reserve would be more like the idiot person in charge of VIP clients at the casino, because the Fed just keeps comping shit. The Fed says, "Oh, we got a big spender here. We're just gonna comp them free food, and we're gonna comp them all this. We're gonna comp them a free shopping spree. Oh, and we'll give them more casino chips. No problem." Got a super chat here from Abbey Road. Thank you for the $100 super chat. It's much appreciated. He is one of over 1,000 Patreon account contributors per month, contributing only $5 a month for unique content, research, information, and analysis, also financial education behind the paywall. There are a lot of articles on a lot of different topics that are interesting, including royalty and streaming companies, precious metal royalty and streaming companies, oil companies, gold and silver miners, uranium companies, and other energy companies. Also, a lot of global macro stuff. So do I think the 80 trillion is going to be that big a deal? I think if it's a problem, I think they won't even tell us. And if things get bad enough, they'll issue a press release. We're in an environment now where the Federal Reserve was able, without actually having to buy a lot, issue tons and tons of press releases with all these. My friend George Gammon covered this, a dozen new bailout facilities that stabilize the markets and cause the asset price inflation, the reflation trade to start with the stock market, the bond market. Look how many new bonds were sold. Besides the stock market rally that the Fed helped financially engineer, look at all the new bonds were sold. Those bonds are going to blow up. Those investment grade corporate bonds, they're not going to be if the ratings agencies were telling the truth, they wouldn't be investment grade. And junk bonds, there was over $300 billion in new junk bonds sold since March and April. Leverage loans, collateralized loan obligations. There's about $400 billion per month now in new mortgage-backed securities, toxic sausage derivatives that Wall Street's cranking out. And then there's trillions of dollars in commercial real estate mortgage-backed securities that are going to blow up. I mean, the Fed's probably going to have to buy all of this stuff. They're not going to buy it all at once. That would devalue the dollar too quickly. It's going to be done in steps. The Fed's balance sheet is going way, 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 way higher. It might be 20 trillion in the next 5 years. It might be over 20 trillion if they tell us the truth. Might be over 20 trillion already. Do you think they would tell us the truth? Someone said that the Fed was, someone tried to tell me that the Fed said that they were audited on their own website. Then why is Dr. Rand Paul and why are Thomas Massie, Thomas Massie is one of the smartest people in Congress. Why are they routinely trying to get legislation for a full and independent audit of the Fed if that was true? It's all about asset price inflation. It's all about higher nominal asset prices, especially real estate and stocks and bonds, and getting those bonds sold. Because Wall Street makes tons of money selling bonds to suckers and cashing out. I know hedge fund managers that were loading up on bonds. They were leveraging up on all those bonds in February, March, April when they were cheap. They knew the Fed was going to issue press releases. They knew the Fed was going to commit to buying them. They knew that they were going to return in value. They leveraged up those trades and they've already made profits. They front run the Fed. They front run other suckers and they've already cashed out. This is the Cantillon effect, folks. It's playing out. It's playing out in a very sad way. It's like John Law from the hyperinflation in the Mississippi bubble. Read about about that corruption scheme. It ended in tears, but tons of people got rich before it ended in tears. J6 asks, is there news from the repo market? The Fed is papering over so many things. The Fed actually, and this is besides the currency swap lines that the Fed issued the press releases for. So the Fed has a permanent currency swap line with the European Central Bank, but they also issued a press release with other G5 countries. So the first press release they issued was for about 5 or 6 other countries, and then they had to issue another press release for additional currency swap lines with Brazil to give them access to dollars. But what most people don't talk about, including the person who made that War on Gold video, who blocked me on Twitter, but there was also a global repo facility. So there's a global repo facility where any country can pledge their treasuries as collateral, and they don't even have to sell their treasuries and get access to cheap dollars. And according to the Fed's own data, no one's using the global repo facility yet, which the Fed has set up. And also the currency swap lines are down enormously, although I suspect that the Fed's probably lying. So the repo madness that I covered, that's when all this started to break. It broke way before the pandemic. The corporate bond bubble, too many US Treasuries sold, the budget deficits the US government was running, the global economy was collapsing way before the pandemic. The Chinese economy was slowing down a lot. We knew this from the export data in Germany and South Korea. The global economy was collapsing way before the pandemic in 2019. And that meant that the U.S. did not have a lot of buyers of treasuries. And that's why we had repo madness back in September. And then the not QE quantitative easing program that Jerome Powell said it wasn't QE, but their balance sheet went up enormously. And they told us back then in October 2019, the balance sheet increase would only be temporary. But most people have a very short-term memory or don't remember at all. Clearly, that was not temporary because the balance sheet's up a lot more. And the balance sheet's going way higher. You have all this extra corporate bond, all this extra toxic sausage, these derivatives that have been created and sold that are going to go bad. They're going to blow up. The underlying assets in there, commercial real estate and others, residential real estate. I have some stories out. There is a real bifurcation, a real unbelievable levels of distortion in home building and rental property and real estate. That'll be a separate show. There are 2 stories there. Both of them are conflicting. And the way I view things is they can't be conflicting for a long period of time. because you have a record amount of evictions coming down the pipe, it looks like in January, and then you have home builders here in the US having record high confidence level, and they're building like crazy over the last 3 or 4 months. They said that business is booming, the home builders. So you have on one end, you have home builders building like crazy, and then you have on the other record evictions. So I don't think both things are sustainable. One of them is either wrong, or one of them is a very short-term thing and it's going to collapse. But the main thing here is the bonds and the treasuries. And then also how the Fed changes the rules. The US government, the Treasury, US Treasury, that's what's prevented. Look, if there wasn't rules changes, Brent Johnson would be right. Brent Johnson was going to be right. February and March, the dollar index was headed exactly where he said it was going to go. I'm friends with Brent. I respect him. But what he's not adding into his calculations is how many rules changes the Fed, how many times they can move the goalposts, how many times they can cheat, and they can do it in an infinite number. And this is the system we're in. So if you're betting on this big dollar spike, if you have big bets on this dollar spike and you're short all the gold miners and you think the gold miners have topped, they're never going to make any more money, that's the most they're ever going to make. The Fed does not want that dollar spike. They know it will collapse the whole system. So they will lie, they will cheat, they will steal, they will change the rules 1,000,000 times to try to either make it a very short-term event or not happen at all. They're well aware of all the dollar-denominated debt, all the forward dollar swaps out there. They're well aware of this problem. So that's why they've kept the dollar in a tug-of-war for now. RR says it's the height of hubris. No, it's the end games of a fiat currency system. The entire globe is on a dishonest fiat currency system. You can be your own personal banker, and you can prepare for stagflation, tax, and lie, because that's the best case scenario. So if the Fed can keep issuing currency swap lines for hundreds of billions, a trillion here, trillion there, soon it'll be real money, many more trillions, and then after the temporary short-term liquidity crisis is over, waive all the loans and say, oh, we never gave up those currency swaps. No one's going to audit us. Those never happened. It's all conspiracy theorists on YouTube. It's all Dr. Ron Paul made up lies. He never got a Fed audit, even though he got members of both political parties in Congress to agree on it. Because there are articles out there saying Dr. Ron Paul made up the one-time partial Fed audit. Now, that's how bullshit it is. So in a fiat currency system where the Fed has absolute power to manipulate with press releases and then issue currency swap lines and then forgive the loans, they don't even have to pay back. The Fed just says, oh, okay, the loan's waived. Are things going to play out the way you think? Or are you going to vote out of the system? And you wonder why smart people are buying Bitcoin, why smart people are buying physical gold, why smart people are buying physical silver, why smart people are buying the dip on the best gold stocks. In a fiat currency system, deflation does not, in a full fiat currency system where the Fed can get away with almost anything, the deflation does not last very long. That's the truth. We had deflation for all of 8 weeks. But if you believe all the government statistics, and you're going to be screaming about me in deflation, you're going to be calling me all kinds of names, you're going to say there is no asset price inflation, blah, 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 blah. Okay. I've had money managers scream at me that there is no asset price inflation. But how do you still have a job then managing your real estate portfolio and your bond portfolio and your stock portfolio? If the Fed and other central banks had not stepped in, you would have been wiped out too. That's the truth. All corruption schemes with too much currency and credit sloshing around out there with the Cantillon effect. And then lots of people telling me that that's not inflationary. Okay, well, thanks for listening. That's a lot longer than I planned on doing. And if you want to take a look at some of the other things I mentioned, they'll be below the video in the information and description section. But the dollar index is still in the tug of war. It's below 93. So this big super dollar spike has not happened yet. It may only be temporary. But again, in a fiat currency system, there is nothing to stop the Fed from changing the rules a million times. From the US Treasury, along with the Fed, changing the rules a million times. From them issuing currency swap lines for a temporary liquidity crisis. Not telling us, only telling us if they think it'll help. Governments only tell the truth when it helps the government. The other majority of the time, the governments lie. They lie and cheat and steal. Because a lot of the people in the government, and I know this because I've been here for 20 years outside the DC metro area, are greedy, very greedy and selfish. And I've had people lecturing me that CEOs and business owners are way more greedy and selfish. Not the federal government employees I met. They're just as bad, if not worse. And I have a bunch of not safe for work stories I can't tell here, or this YouTube channel would be down. Okay, everyone. Thanks for listening.